The US economy, is it going into or is it already in a recession? Recent data have sent recessionary bells ringing, and investors have been scrambling for safety. In this video, we look into the three key metrics that has been screaming that a recession is imminent. But first, to understand why we're talking about a possible recession, we have to look into what has happened over the last few years. Back in 2020, when the global economy was hit by a COVID pandemic, this resulted in the perfect storm of supply chain disruptions, increased demand for goods, labor market imbalances, and expensive monetary and fiscal policies, and the rising of commodity prices, which in turn saw the US inflation climb to a 40-year high of 9.1% by June 2022. And in order to combat those high and historically high inflation rates, the US Fed Reserve started hiking rates aggressively from March 2022 to the current levels of 5.5%. Now, with the inflation rate down to 3%, the US Federal Reserve has started signaling that they're ready to start cutting rates, possibly at the next meeting in September. Looking at the Federal Reserve's rate decisions over the years and overlaying it with when the US economy was in a recession depicts a scary trend. The last few times that the Fed Reserve cut rates from their peak, a recession followed. But if we look more closely at the previous recessions, we can see that the rate cuts came after the recession started, as a way to get the economy out of the recession. It's also important to remember that the Federal Reserve is now planning to cut rates not because it is thinking that a recession is imminent. It possibly is. The reason why the Fed Reserve is cutting is because they have hiked it so aggressively in the previous years to bring inflation down. And now that inflation rates have come down, although still slightly higher than their target, they can actually start cutting rates. Which brings us to our first key metric, the unemployment rate. Rising unemployment rates are a key indicator of a potential recession. The Fed Reserve had previously indicated that while employment data was still strong, there was no rush to cut rates. However, at the most recent meeting, Chair Powell from the Fed Reserve stated that there was a real downside risk to employment numbers, and they had to find a more balanced or equal balance between their employment and inflation goals. In fact, last Friday, the US unemployment rate was released at 4.3%. The unemployment rate has been actually rising since March 2024 from 3.7%. This also triggered something known as the Salm Rule. Named after American economist Claudia Salm, the rule says that if the average unemployment rate over 3 months is half a percentage point higher than the lowest level over the last 12 months, then the country is at the beginning of a recession. In this case, the US unemployment rate rose in July, so the 3-month average was 4.1%. That compares to the lowest level over the last year, which was 3.5%. Persistent increases in unemployment rates often signal that the economy is contracting. A rising unemployment becomes a problem, especially as more people lose their jobs. They will have less disposable income, leading to a decline in consumer spending. This reduction in spending can also further slow down economic growth. And when businesses face economic difficulties, they often cut costs by first reducing their workforce, creating a negative feedback loop. Additionally, high unemployment can lead to a decrease in consumer confidence, causing people to save more and spend less, further worsening the economic slowdown. Which again leads us to the second key metric, consumer spending. Consumer spending has helped carry the US economy past recession's forecast in 2023 and has remained resilient through the continued high inflation and interest rates that remained at 2-decade highs. However, there is rising concern that the pace of consumer spending, the core engine of the economy, is slowing down, as weaker personal income and lower discretionary spending results from the rising unemployment rate. Economists expect consumer spending growth to moderate down to slow down through the later part of 2024. The effect of interest rates can be seen on consumer spending in some categories, especially as pandemic-era savings are spent down. The high interest rates have left a mark especially on large ticket items like motor vehicles and large durable goods, often bought with finance. Consumer spending is a key indicator of predicting economic recessions because it accounts for a significant portion of GDP, reflecting on overall economic activity. A decline in consumer spending can reduce business revenue, leading to cutbacks in production, layoffs, and reduced investments, all contributing to an economic downturn. However, consumer spending is also one of the indicators among many, like unemployment, interest rates, and inflation, which are also essential for assessing the likelihood of a recession. And we come to the third key metric, the inverted yield curve. The US Treasury yield curve can indicate a recession through an inverted yield curve. Historically, an inverted yield curve have preceded many recessions, making them a closely watched indicator by economists and analysts all around the world. Typically, a long-term investment yield higher returns to compensate for the risk of tying up funds for a longer period. This principle stems from the time value of money, where money available today is more valuable than the same amount in the future due to its potential earning power. Investing for a longer duration means foregoing other potential uses of that money. Moreover, longer-term investments carry greater risk, such as economic fluctuations, interest rate changes, inflation, and geopolitical conflicts and events, which can significantly impact long-term investments. To offset this risk and the opportunity cost of tying up funds, investors demand higher returns. Therefore, the higher yields on longer-term bonds act as a premium to compensate investors for the added risk, uncertainty, and reduced liquidity over time. An inverted yield curve is significant because it suggests that investors have lower expectations for future economic growth. It often reflects concerns about future inflation or a lack of confidence in economic prospects, prompting investors to prefer safer, longer-term investments despite lower yields. When comparing against the 10-year Treasury yield to assess recession risk in an inverted yield curve, analysts often look at the following short-term Treasury yields. The 2-year Treasury yield. This is one of the most common comparisons. An inversion between the 2-year and 10-year yields, which is when the 2-year yield is higher than the 10-year yield, has historically been a reliable indicator of impending recessions. Another widely used comparison is between the 3-month and the 10-year yields. An inversion here is also considered a strong recession signal. The Federal Reserve monitors closely this spread. While less common, some analysts also look at the 1-year yield in relation to the 10-year yield for additional insight. However, when investors anticipate economic downturns, they often look for safer investments. Longer-term bonds are considered safe because they provide steady returns over a longer period. As more investors buy these long-term bonds, the demand increases, which in turn lowers the interest rates or the yields on these bonds. This is why the yields on longer-term investments can decrease when there are fears of an economic slowdown. The current 3-month, 2-year, and 10-year Treasury yield clearly shows the development of an inverted yield curve now. So, are we in a recession? Not necessarily. While we do have the 3 key metrics of rising unemployment rate, lower consumer spending, and an inverted yield curve to signal the potential or the possibility of recession, typically it also needs some shock that happens to an economy to get into a recession. Remember that in the financial markets, correlation doesn't always imply causation. Eventually, we will have a recession. Recessions are really just part of a normal economic cycle, so you shouldn't hold your breath for one. If and when interest rate cuts do come, this could help pull the US out of or delay a potential recession. Ultimately, we look forward to further economic developments, the possible reactions from the Federal Reserve, and the actions in the upcoming September meeting. If you found this video useful, please do leave a comment and remember to like and subscribe. I look forward to bringing you more updates about the markets in the upcoming video. If you found this video useful,